The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A Micron moment for the broader market. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. Kicking off the closing bell here in the U.S., you look at an S&P 500 on track for a third straight day of losses. At the individual level, you actually have more gainers than losers right now, but it's all the important names that are falling. The big tech names, as evidenced by the NASDAQ 100, down about 1%. Chip makers also falling ahead of those Micron results coming after the bell. And you're seeing this downdraft in markets, even though you have Brent falling to the tune of about 5% right now. We were below $70 a barrel or close to it earlier, and you can see that slide continuing. Might explain what we're seeing in the bond space. Yields currently down about 10 basis points when it comes to your 10-year Treasury yield, Romaine, down below 440.
Yeah, we're going to talk a little bit more about those yields. We're going to talk a lot about Micron, the third biggest weighting in the NASDAQ 100, and the index's third best performing stock so far this year. And while it's more than tripled over the last 6 months, it's down about 15% since that record high on Monday. Of course, that was after that report that competitor SK Hynix is actually slowing chip production growth. That means the go-to look in Micron's earnings release will be details on the depth and the durability of the company's long-term supply backlog to support the market's sky-high chip demand narrative. It's a gut check moment, to be sure, to quote Dan Ives. But let's not forget why Micron is one of the hottest stocks in the world. 9 straight quarters of double-digit percentage revenue growth, and what today is likely to be a second straight quarter of triple-digit revenue growth. That's on the back of 80% gross margins, and that's on the back of $850 billion in commitments to future data center leases from the largest cloud computing companies in the world.
We're in the midst of the largest concentrated CapEx boom in at least 25 years. And by year end, this CapEx boom could be larger than in any of our lifetimes. And, you know, this is concentrated, of course, but there are a lot of very positive spillovers.
Yeah, those spillovers, one of the reasons J.P. Morgan strategists boosted their year-end price target for the S&P to 7,800, up their earnings per share estimate to 350. They cite a blue sky scenario aided by AI infrastructure spending that may, Katie, blunt any headwinds we get from a hot inflation report.
So some optimism as you see the broader indexes wobble. A lot of questions about that AI trade, and it's going to be interesting to see where Micron fits into the picture. But let's talk about the stock, how it's being treated by traders, because it's fascinating. If you take a look at its 20-day average traded value, Micron actually is now the most traded stock in the U.S. That is that white line there, Micron. That compares to NVIDIA in blue, Tesla, and Alphabet. That's your purple stock here. So we'll see how this goes after the bell today. You think about Micron. You mentioned its performance year to date. It accounts for nearly a fifth of the gain that we've seen in the S&P 500 this year, but we know it has a pretty tricky history when it comes to its post-earnings day reception by the market, falling more often than not in recent quarters, Romaine.
Absolutely, and we're seeing a bit of a rotation away from some of the picks and shovels of the AI trade to the companies that are actually benefiting from the use cases, and that's where we want to start the show today. Racquel Oden joins us here in Studio 2, U.S. Head of International Wealth, Asset Management, and Global Private Banking at HSBC, and they're fresh out with a new report here about AI use amongst investors. I do want to touch on that report in one second, but I do just want to get your thoughts about the importance of Micron, and I guess really more the broader chip space right now to kind of keeping this rally going.
Yeah, so I think what you're going to see, which importantly, as you're all seeing, we have to really ensure investors stay focused on the long term. But I think, as you've just shared here, the importance of what we're going to see from Micron is clearly impacting the markets. But it really is the short-term volatility between the oil prices and, very importantly, interest rates. You have a Fed chair that's indicating different directions, and there's a direction that if interest rates were to go up, that definitely will impact the chip sector overall. But there's also indication that we have the opening of the Strait. And if we keep the peace treaty going right now, that is the reason why you're seeing oil prices drop again. And then importantly, you're seeing hopefully a rally in the market should that stick. So right now, short-term volatility, but I would tell you what we're telling our investors, this really has to be the long-term play.
Well, let's talk about the long-term play. Certainly AI is going to be at the center of that. And we're starting to talk a lot more on this show over the last few months, more about the use cases rather than just who's buying chips, who's building data centers. HSBC has a new report out talking about how investors have utilized AI. And I am curious as to sort of what you found in that study. And more importantly, as somebody who is managing other people's wealth, does that put your job at risk?
Well, that is a great question.
Yeah.
So no, but I think what's really important about that is you're spot on. So with this research report, with the impact of AI, and by the way, every sector, every industry needs to be looking at the impact of AI on your business. And we wanted to hear this from our clients' view so that we make sure we're responding to their demands and what they expect from us. We did a research report of over 10,000 affluent investors globally, and I think that's a really important context. And it's giving you a view that it was across 10 countries. And in that, the U.S. represented about 1,000 of those particular participants in the research. And what we found, very importantly, is absolutely our investors and our clients are embracing AI, but importantly, majority and almost 70% of their decisions are absolutely still made on an individual advice and a human being giving them decisioning. So what we found is AI informs people. They're very knowledgeable, but to actually make a decision, they want to do it with a human being.
And it's really interesting, I mean, to take that and think about what you actually titled this research, the AI trust threshold. And you think about how trust plays into that. It sounds like what you're saying is that, I mean, AI is being used as a tool, but these investors don't necessarily trust it to make the final decision.
So exactly. So trust is at the core of it. We call it the trust threshold. So that's going to be a narrative or a nomenclature you're going to hear us using quite a bit. And what AI isn't able to replace is a trust threshold. But what it does do, it allows our investors and our clients to be a lot more informed. It absolutely is building confidence. And importantly, it is about us embracing something we're calling something new, which is the hybrid model. The reality is investors are going to be leveraging AI as part of their decisioning making. But the hybrid model says that 80% of that decision is still going to come from a trusted advisor outside of what they've been informed by with the AI. Where we really saw a difference was in the, what I call Gen Z, millennials versus baby boomers, right? And one would think like there should be a dramatic difference based on the fact that you have millennial and Gen Zs and Gen X that have been embracing AI a lot more than baby boomers. But what we actually found, again, even with the difference of the generations, when it comes to decision making, they ultimately still landed in that 19% saying AI is when I'll make a decision on something, still wanting to look for the 80% that are truly saying, I still want to speak to a human being because it's about a decision and I'm looking for advice.
That is really interesting because you would think that it's more in the muscle memory of those younger investors to more fully trust AI. But, you know, when we're talking about decision making, when we're talking about wealth management, there's a lot more that goes into it than just, you know, this stock is going to go higher, this stock won't. I mean, when it comes to where AI is useful versus where you want the human edge or the human touch, I mean, what does that decision tree look like?
And I love that you said that because it's exactly how clients refer to it. It's the human edge, right? And whoever thought that we'd see ourselves as the edge, but we are, right? Because it's the layer that we add, which really allows us to help clients manage complexity. So what we did absolutely see is the more complex the client is, and more importantly, more affluence they have, AI gets really small in their decisioning factor. It gets even smaller, right? And doesn't matter what generation it is, that really is a huge factor. But where AI is super important is the ability to allow for our advisors to have more time to spend with clients, right? It's about the efficiency gains of one, importantly, which is all the administrative components that go with it really allows them to really listen, spend time with clients, and actually serve more clients. And so the benefits are absolutely there for the industry, but the need for human touch and the need for advisors still stays really strong.
All right, Racquel, great stuff here and an interesting report here. The AI Trust Report from HSBC. Racquel Oden is U.S. Head of International Wealth, Asset Management, and Global Private Banking at HSBC. Kicking us off to the close as we're going to talk a lot about AI today as we await those earnings out of Micron. Remember, it's been the semiconductors, it's been the technology, hardware, not only driving the market, but also driving the economy. We're going to catch up with Wang, Global Head of Capital Markets Research and Chief Economist over at Vanguard's Investment Strategy Group. She's going to be stopping by with her mid-year outlook. That's coming up next, right here on The Close, right here on Bloomberg.
SK Hynix seeking north of $29 billion in a landmark U.S. listing set to debut on July 10th, a key milestone in the memory frenzy that has sparked market volatility in recent weeks. Our next guest is out today with her mid-year outlook and sees tension building between near-term earnings momentum and AI's ability to deliver sustainable medium-term growth. Joining us live, I'm pleased to say, is Qian Wang. She is Global Head of Capital Market Research in Vanguard's Investment Strategy Group, also Principal and Chief Asia Pacific Economist. Great to have you with us in person.
Wonderful to join you, Roma and Katie.
Well, let's talk a little bit about that tension that you see brewing when it comes to the earnings momentum that we've witnessed in the past few quarters, and whether or not these companies, particularly these AI companies, are going to be able to keep that going.
Yeah, I think when you look at the market around, over the past few quarters, it does have a lot of fundamental support, right? It was supported by earnings growth, really strong earnings growth, realized and expected, instead of valuation expansion, right? But, it can be a powerful trade, and we do think it has further legs to run. But the thing is that when expectation is very high and is so concentrated, there is going to be a lot of volatility, especially when market is starting to ask the question: can those massive investments turn into sustainable and broad-based profit in the long run? I think this is where it can be a powerful trade, but it's a very fragile trade. Investor must be experiencing this kind of bumpy ride at this moment.
Is that true when you take a look at markets outside the U.S. as well? Because you think about Asia Pacific, specifically, South Korea and Taiwan, where you have a lot of chip makers as well. Does that dynamic hold there as well?
Yeah, I think when you think about this trade at this moment, it's really on this one story. It's actually the early stage of the AI cycle, that is AI build out, right? So when you think about the global AI complex, that's like 70 companies across the world, right? Then it includes U.S. companies, tech, hyperscalers, but also includes a lot of enablers, right? Along with this whole supply chain of the semiconductor, data center infrastructure. Right, that's where you see, Asian is actually really, getting a strong ride as well. We think the AI capex cycle still have, a year or two to run, right? This is like historical massive investment cycle. The inference demand just, starting to scale, and the supply constraint is generating. So there could be some, the earnings momentum can continue to strengthen in the near term.
I am curious about how you quantify the economic impact of this. The Treasury Secretary last night was giving a speech, and he talked about just how much AI infrastructure and the spending on that has contributed to U.S. GDP. When you look at Asia right now, particularly into Korea and some of the other nations that are at the center right now of this build out, are they also seeing a similar economic bump from this?
Oh, definitely. In fact, I would say the lift to the Asian economy might be even more, right, than the lift to the U.S. because U.S. has a large component of this AI investment that is actually imported, right? So then on net, the contribution to GDP growth may not be as impressive as the AI capex number. But when you think about the lift to those Asian, like smaller economies, then the lift up to the exports and the following investment in coming years are quite significant. So I would say, yes, they will continue to benefit for this at least, this year or next.
I am curious, particularly with regard to your mid-year report. I mean, was there something significant that changed in this report relative to what your stance was 6 months ago at the start of the year?
Yeah, well, I would say, from a cyclical perspective, I think it's really because of the oil shock, right? That actually is a stagflationary shock to the economy. But on the other hand, our conviction in AI's economic potential, both in the near term and long term, actually has increased, right? So our economic outlook for this year for the U.S. actually has stayed largely the same. Inflation is a bit firmer, central bank is a bit tighter. But I think what's more important is that, like for 2027, we are actually expecting 3% growth. It's actually much higher than the consensus, which is still around 2%, right? And that is not a cyclical after. That is really a structural transformation because we are more confident about this upcoming AI investment as well as the productivity gain in not just next year, but also the coming decade.
Is that forecast dependent on an increase in spending on CapEx or just kind of sustaining what we have already?
Yeah, I would say this is where the contribution, right? That increase of CapEx will continue, right? This year we are talking about, hyperscalers, 700 billion over, and then next year we are talking about 1 trillion, right? So the number as indeed have further room to grow in the next couple of years. That is where I think, but also it's more than just AI CapEx. We are starting to see what more widespread adoption, right, beyond the tech sector, and that productivity gain is something that is going to sustain, this higher economic growth next year.
Absolutely. A lot of people looking for that. Qian, great to have you here.
Thank you.
Some great insights here with their mid-year outlook. Qian Wang, Global Head of Capital Market Research and Vanguard's Investment Strategy Group here. As we keep an eye on tech stocks, Micron down about 5%. Qualcomm taking a leg down since Investor Day is underway. We're going to take a break from talking about AI and pivot to the world of healthcare. And we're going to look at it through the lens of small businesses. Morgan Health CEO Dan Mendelson lays out the disproportionate cost pressures and the key considerations for the industry when we return right here on The Close, right here on Bloomberg. All right, health insurance costs. They are disproportionately impacting small businesses here in the U.S. That's according to a research report out this month from Morgan Health, the division of J.P. Morgan. It's investing in improving the quality, affordability, and equity of U.S. healthcare. Small business owners saying that they're ready for better health insurance options and tools out there, and maybe AI could actually be part of that solution. Joining us right now is the CEO of Morgan Health, Dan Mendelson. Dan, great to see you again.
Thanks for having me.
Healthcare costs, let's face it, for large and small businesses has always been that bugaboo, but let's talk specifically about whether there's any sort of, sunlight on the horizon for small businesses in trying to manage those costs and maybe even actually get them down materially.
Look, this is a really serious problem. Yeah. And imagine, you're running a coffee shop or a flower shop or a laundry, and all of a sudden, at the end of the year, you see that your premiums are going up by 20 or 25%. And you want to cover your employees. In a lot of cases, they're family. In a lot of cases, they're like family. But small businesses are really struggling with this right now, and it's causing very serious problems, and there just aren't a lot of good options.
I'm curious. I was just looking at some data today, and this is for all businesses, not just small businesses, and looking at the average premiums for households as well as the average cost for companies, and it just keeps going up. Year over year over year. And I guess my question is, what do you think is the solution? The whole reason Morgan Health exists is, that was originally supposed to be part of the solution, and I'm sure it still is. But in terms of seeing a broad-based impact in this country, what does it take?
Look, costs are going up because of new technology. GLP-1s, great technology, very expensive. So these are the kinds of things that are driving costs. Costs also go up because of labor. If you go into a hospital, 70% of the hospital costs are nurses and doctors and the people helping you get better. And so there's always going to be cost escalation there. What we're focused on is trying to find solutions and fielding those solutions in practical effect. And there are good solutions. So, for example, better use of technology, better use of AI in clinical medicine is one. Selecting a subset of the hospitals or doctors in a particular geographic area that can bring down costs because you get better deals with them. If you subset it, that's another way to drive costs down. So, the goal of our group, and we've got now 12 portfolio companies that we've invested in, every one of them is focused on better affordability, better quality, and in many cases also better health equity.
Well, that's what I wanted to talk about, those 12 portfolio companies that you do have. What does the opportunity set look like right now as you look for solutions and companies that are trying to create that? And how much dry powder, if you will, do you have to sort of put behind those ideas? Yeah,
there are solutions. And, for small business, for example, small businesses can find a narrow network plan that in some cases is 15 to 20% less expensive than a very broad panel plan. There are also mechanisms called individual coverage healthcare reimbursement accounts, kind of a mouthful. ICRA is the acronym. But effectively subsidizing your workers to purchase insurance in the health insurance exchange. That's another way that businesses can cap their liability and continue to be able to provide the coverage that they want to their workers. And then we have some great companies that are focused on very specific areas. So, for example, in cancer care, when a person is diagnosed with cancer, if they have better care navigation to help them find less expensive and higher quality care, It's often the case that their oncologist might not be helping them find a place near their house where they can get care.
And I do want to dig into, some of the details of this report that you have out, because I thought it was really interesting that, when you think about how small businesses are approaching their health insurance, that at the end of the day, the last thing they want to do is basically cut benefits here, that they'll take all these sorts of steps to preserve those benefits. And, I wonder what that actually looks like in practice. I mean, if you're trying to have as many benefits as possible, what levers can you pull?
Yeah, Chase banks about 7 million small businesses in the United States, and we hear from them. We've done focus groups. We hear from them organically. They call us because they're struggling. And it's really about finding better options because they do want to continue to maintain coverage for their workers. So they need lower cost, they need better quality, because they're also hearing from their employees about quality. People can't find a doctor. People in New York City can't find a primary care physician, for example. Very difficult to find that kind of care. And so, what we're about is arming them with tools. It might be a narrow network plan. It might be these individual coverage models. It might be, kind of finding better ways to give tax advantage dollars to workers. And in some cases, a business might not be able to afford offering coverage at a certain point. But I would say that, by and large, the vast majority of businesses want to be able to cover their workers.
I do just want to go back for a second to the drug issue, and pretty much, and this is more about kind of this next generation. And we know how high the costs are to develop these things. And out of the gate, there's obviously a lot of associated costs with that. How do you balance out this idea that we are kind of at this inflection point with regards to drug discovery, of really being able to provide a huge improvement to our lives, but that's obviously going to come at a big cost to the drug developers and presumably for the insurers.
For sure. Yeah. I think in a lot of ways the GLP-1s have been a wake-up call on this subject because, again, it's technology that employers want to make available to workers, but it does come at a cost. And we see routinely now a lot of employers are spending 2, 3, 4, up to 5% of their healthcare spend on GLP-1s. And so if you think about kind of this next generation of cell and gene therapy, for example, where those drugs might cost between $1 and $5 million every time they're used, it's a lot of money.
All right, Dan, unfortunately, we're up against the clock. Great to get some time with you. That is Morgan Health CEO, Dan Mendelson. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. And we were just having a really interesting conversation on GLP-1s, the cost of GLP-1s for employers, and these sort of specialty drugs being part of the reason why you're seeing healthcare costs for employers continue to rise.
But then I thought, Dan kind of touched on this idea, too, that also some of these drugs have other health benefits that maybe if you, reduce the, some of the other chronic potential ailments that you would have had without those drugs, then maybe that lowers the healthcare costs, or at least it makes the cost maybe a little bit more in line with the benefit.
Absolutely. You think about all the comorbidities that obesity does have. Something we spent a lot of time talking about a little bit earlier today in the context of Novo Nordisk, because their shares are just about flat year to date, but their GLP-1 business is in focus with Medicare beginning weight loss drug coverage on July 1st. Now, earlier today, we sat down with Jamey Millar. He is Novo Nordisk's Executive Vice President of U.S. Operations, to talk about what's next for the pharma giant. Here's part of that conversation.
A bit of uncertainty whether there will be a bolus kind of volume of patients immediately July 1st or whether it will come over time. But we've been preparing for either situation, working with healthcare providers to educate them on the CMS Bridge program and patient eligibility criteria, as well as pharmacists who will largely fulfill the prescriptions for the Medicare beneficiaries.
And like you said, I mean, plenty of uncertainty here, but I'm curious, what your projections look like when it comes to older Americans, whether you're expecting they'll prefer the pills or the shots when that reimbursement program does roll out.
Great question. We've done some primary research on that question, and about 75% of Medicare beneficiaries do state intentional preference toward weekly injectable or daily pill. and the favorability toward the pill is 2 to 1 in that preference. So quarter of seniors are undecided as to form, but those who declare a preference prefer the pill on a 2 to 1 basis.
Is that preference just simply because of the difference between a shot versus a pill, or is it more about drug interactions and some of the other issues seniors might face?
I think primarily it's the concordance with the multiple medications they're already taking. Average senior takes 8 medications, most of them oral, and most of them filled at retail pharmacies. So this program will flow in a natural way, the way seniors have been interacting with medication.
Are you confident about the number of new consumers that you'll get through the CMS program? And more importantly, are you confident that the reimbursement rates are going to make it worth your while?
Yeah, in terms of activation, CMS and CBO estimate about anywhere from 15 to 20 million eligible patients. From there, you would deduct patients that already have coverage to Wegovy, for example, for cardiovascular disease as a primary indication. As we discussed previously, Wegovy is the only GLP-1 that's proven a reduction in cardiovascular risk, specifically cardiovascular death, MI, and stroke. So that's already approved through Part D plan sponsors, as well as fatty liver disease, MASH. So you deduct from the 15 to 20 million, and then how many patients will be motivated to seek treatment? Systemically in the U.S. across the opportunity, we've seen about 10 to 12% penetration or activation of patients against the eligible population. So CBO has used that 10% as a marker. In terms of your second question, affordability, $50 out of pocket per month in this program, which is really nice affordability, recognizing, however, that many seniors on fixed incomes will still find $50 a month unaffordable.
Well, to your first point, I mean, you think about obesity comorbidities. What proportion of your volume when it comes to Wegovy currently comes from Medicare and Medicaid when you think about their use treating those comorbidities?
Yeah, it's a small but growing part of our overall volume. MASH in particular just was introduced late last year. The benefit in terms of cardiovascular outcomes is well known and acknowledged with semaglutide. So we see a large part of our growing business in the self-pay, direct-to-patient, opposed to the traditional reimbursed. Clearly with pill, we're about 90% of our volume with Wegovy pill since launch has been on the self-pay side versus reimbursed.
That's actually what I was wondering. You know, when you think about that direct-to-consumer channel, what the difference between the pill versus the injection looks like. So for the pill, very heavy volume there. What does it look like on the injection side? And you know, are there any trends that are developing there?
Yeah, on the injectable side, about 30% of our business is self-pay. So we see, you know, a blend, a mix of reimbursed traditional coverage and the self-pay. I think the opportunity here with Bridge is the $50 out of pocket. Our self-pay prices start at $149 for the pill, $199 for the injectable. So $50 out of pocket is certainly attractive for seniors that now for the first time have coverage for the obesity indication, which is super exciting.
Do you still have plans to actually raise that price from the introductory level from that $149 to $199?
We have no plans to change the pricing construction on the self-pay side. And the early adoption of Wegovy pill has been stellar. So we have exceeded 3 million total prescriptions since the launch of Wegovy pill. We did the first million in the first 12 weeks. We did 2 additional million prescriptions in the next 10 weeks. So it's even accelerated in the face of competition.
I also want to talk about dosage as well, because you think about high-dose Wegovy. It was approved a couple of months ago. What have the past few months looked like in terms of uptake when it comes to the U.S.?
Yeah, we've seen almost, I'll call it a halo effect on the franchise with the stellar growth of Wegovy pill, but also growth in Wegovy injectable. So there's kind of a harmonious effect, if you will, a synergistic effect, you know, across the brand. And we are the only molecule that's available in both an injectable and oral form.
But on the rare disease side, and I mean, a lot of investors have talked about it because obviously the margins, at least from what we can see, are a lot higher. But that's still such a tiny percentage of your business in terms of revenue. So what actually gets that up from, the mid-single digits into something that's maybe a little bit more palatable to Wall Street?
Yeah. To your question about ongoing conversations, we continue to look at adjacencies and potential bolt-on M&A activity to expand the breadth of our portfolio. But we have a rich pipeline in both diabetes, obesity, rare disease, cardiovascular disease that is emerging. And we anticipate in September to share the latest on that pipeline activity and the corporate strategy at our Capital Markets Day.
So, you think about your chief rival when it comes to the GLP-1 space, Eli Lilly. They've been extremely acquisitive, especially when it comes to expanding their pipeline. It sounds like you said that, Novo might be interested in a potential bolt-on acquisition. Would you be considering a blockbuster deal here when you think about, potentially expanding that pipeline?
I think, we're open to, opportunities, I think, more likely in the bolt-on category, delivering synergistic kind of adjacencies to the current portfolio. But yeah, there's a bright future both in the pipeline and potentially opportunities outside.
That's Jamey, Millar, Executive Vice President of the U.S. Operations at Novo Nordisk, of course, the company's biggest market here in the U.S. You can watch that full interview on Bloomberg.com/videos. Now, we do want to bring you some breaking news right now. This is on Alibaba. Its ADRs, which were down about 2% just a few moments ago, dropping about 3%. This on the back of a report just put out by Bloomberg with Anthropic, of course, the big AI company, accusing Alibaba of waging a large-scale effort to illicitly access its Claude artificial intelligence model. This is according to a letter that Anthropic apparently sent to several U.S. senators and White House officials. Bloomberg reporters have seen that letter. We're going to try to get you some more details on that. Katie, I'm not exactly sure what the implications would be here, but this does look like it even goes beyond Alibaba in terms of the accusations, at least as to what Anthropic is describing as a large-scale effort by Chinese developers to, I guess, use without permission some of Anthropic's LLMs.
Absolutely. The company Anthropic saying this is the biggest attempt so far by a Chinese company to piggyback on the work of top U.S. labs. Like you say, of course, going to be following this quite closely, but you can see the reaction in shares of BABA right now falling to a session low, down about 3% after hours.
All right, we'll get you some more details on that. Meanwhile, we do want to turn to another stock that's moving in the opposite direction. Wendy's, remember them? They're up 25%. It's part of a meme stock mania that's back in force. That's coming up next in our Stock of the Hour, right here on Bloomberg. Time now for our Stock of the Hour, and it's the best performing stock out there across the tape, Wendy's. Sizzling after a post on Reddit, on the Reddit forum, Wall Street Bets, basically a bunch of investors, retail investors trying to ignite a rally, and it looks like they have. Nora Melinda joining us right now. Talk a little bit more about this. The shares at one point were up about 40%. It's funny, I actually saw this post the other night, and I didn't think much of it. I just thought it was, people popping off, but apparently there's a lot of juice to this. What's going on?
So you were just scrolling late at night, just going through, and you came across this post.
Yeah. Well, I have a burner account there where I just stir up mess. So,
now I'm so curious.
Yeah.
Well, here, of course, we're seeing yet another meme stock rally. I mean, I covered the meme stock rally really closely last year when we saw Open Door, Krispy Kreme. GameStop is a name that we always think about when it comes to any sort of meme stock mania. Well, Wendy's here, what I'm hearing from sources, a bit of a nostalgia trade. But not only that, of course, any sort of stock that you're going to see that has high short interest, which to point out a number here, we're seeing short interest of about 24% of this stock's float. And so you're going to see those as some companies that retail traders are going to target online to see if they can really force these short sellers to cover their positions and further driving up the stock.
So Wendy's, yes, this feels very meme stock-ish, but I mean, Wendy's is a real business here. And I wonder, what do the fundamentals actually look like? Of course, you can't match fundamentals to what's going on in the stock today, but I mean, what sense do we have of how this company is actually doing?
Well, the stock is down about a little bit more than 5% year to date, but the company has really been trying to turn around sales. They had a new CFO that was just announced on Tuesday. Many analysts on Wall Street rating the stock at hold. But it's not a terribly performing company. But if you do look at the price on the stock right now, sitting at about just below $8, it's not an expensive stock. So when you see a lot of these cheaper stocks, those are also more attractive. And you see retail traders coming in with the same formula that we saw with Krispy Kreme, GameStop, and a few of the others.
Yeah, I mean, I was just looking at the rate of change on the Bloomberg terminal, and I mean, there really is no precedent for a one-day gain like this on Wendy's. Is this sort of a widespread thing with regards to the meme stock, or is this just kind of the one-off for Wendy's?
In 10
Some folks having
seconds.
something there.
Yes, I started looking at the others. We do see Wendy's up more than 20% right now. Krispy Kreme, also, ticker donut, D-Nut, my favorite, up about 8%. So we are seeing a bit more of the
There you go.
some traction.
All right, Nora, Melinda, thank you very much. This is the close.
The importance of what we're going to see from Micron is clearly impacting the markets, but it really is the short-term volatility between the oil prices and, very importantly, interest rates. There's a direction that if interest rates were to go up, that definitely will impact the chip sector overall, but there's also indication that we have the opening of the Strait, and if we keep the peace treaty going right now, that is the reason why you're seeing oil prices drop again, and then importantly, you're seeing hopefully a rally in the market should that stick.
Racquel, Oden over at HSBC, kicking us off to the close just about 50 minutes ago as we count down to those bells and count down to those earnings from Micron.
And it looks like the S&P 500 is going to finish lower. That will be a third day of losses. And it's really interesting, the composition of this decline, because you have more than 300 names in the S&P 500 actually finishing the day with gains. But again, it's all the important names that are falling right now. A lot of the big tech names, a lot of the chip names, to your point, ahead of those Micron earnings that we get in a couple minutes' time.
Absolutely. Micron under pressure. We should point out Cerebras, which just went public last month, had its earnings report yesterday. Those shares down 19%, below their 185 IPO price from May 13th. We're going to talk a little bit more about what's been going on in the AI space and the big sell-off there. But we've also got a big rally going on today in Treasury yields. In fact, the benchmark 10-year having the biggest one-day rally that we've seen all month. Jeff Sherman joins us right now, Deputy Chief Investment Officer over at DoubleLine Capital. And Jeff, I do want to start there with some of the moves that we've seen as of late in the Treasury space and what we can maybe read into it about where it goes next.
Yeah, I mean, what we've seen is really the repricing. I think it's still back to this kind of oil trade once again. Once we've seen that relief down, we saw crude oil, at least front crude, get to right around $70 a barrel today. And so I think it's just taken a little bit of this like excess inflation pressure off there. And you've seen this really, especially on the front end. You referenced the 10-year Treasury, but we've noticed that it's in front end break evens have really collapsed over the last couple of weeks. I mean, I saw the break even rate this morning at around 2% on 2-year Treasury. So we've seen this kind of 2-year Treasury real yield continue to accelerate for really, I'd say, the last 2 weeks now. So in general, I think what you've seen is just a little bit of a relief rally, potentially that, if there is this new traffic opening through the Strait, just the supply of oil coming to the market. But, still questions still linger out there because it's not just opening the Strait and getting this supply of oil out. We have to see what the flow of traffic will look like of actually trucks, of ships entering into the Strait as well. So I think there's a lot of challenges there. But in general, what you're still seeing is like, the bond market still needs a real yield that's positive. That's what we're seeing out there in 10-year Treasuries today. I think it's just a little bit of this excess of some of that kind of commodity-driven inflation that was priced in the market for the last couple of months.
And when you think about what we heard from the Fed last week, though, and their new estimates for where they expect inflation to go, they also revised higher their estimates for core inflation figures as well, which would suggest that, the type of price pressures that maybe they're anticipating in the year ahead, they aren't solely energy driven. And I wonder, how you're thinking about that, especially as you watch that collapse at the front end.
Yeah, no, definitely. And I think it's very important to realize that, core inflation still has a problem. And when we say core, that's after stripping out food and energy prices. And so this is the reason that I think the bond market woke up to Chairman Warsh's first press conference and said, oh, wait a second, maybe the Fed actually is in play, and it's not the Kevin Warsh who's a crony, let's say, of the president, and he's going to do, some political posturing. Instead, he's going to be focused on the inflation side, and the bond market really woke up to that last week. So I think when you think about it and you look at the pressures there, you're just not seeing this dissipation in core inflation. Yes, it has come down off the elevated levels from a couple of years ago, but we still have something with a 3 handle on it. Even though Chairman Warsh said he only likes to look at the number left of the decimal point, I don't think a 2.9% inflation rate on core inflation would be something he would celebrate either. So I think that's what you've seen really in the calibration here. But in general, it's going to be hard for the Fed to kind of hike at where the bond market's pricing it right now. You have roughly a hike coming, let's say, around September, and potentially another one by the end of the year implied through the futures markets. But if you really think about that puts you roughly about, let's say, 6-7 weeks from the midterm election. So I'm not sure that Chairman Warsh would want to do that in front of the election as well. So he may continue to be patient. The problem with the patience is that if we have some reprice of oil back upward and they continue to be too patient, then potentially later on they have to make that up with, let's call it a 50 basis point hike later on if that core inflation stays there. So, as we've discussed on your show before, we've been in the camp where we just think it's very difficult for the Fed to cut. Probably the bias should be towards a hike at this point. The Fed itself probably kind of wishes they didn't do maybe 1 or 2 of those emergency cuts we got last year. But we'll have to wait and see. And I think it's going to be data dependency, as Chairman Warsh told us. We got 5 weeks now until they meet again. And so we'll see if he's any more revealing with any information and how those task force are progressing.
Hey, Jeff, I do want to get your thoughts here on what we've been seeing with regards to artificial intelligence, particularly given all of the debt issuance that's already out there and what most people anticipate will be a lot more coming out there. I know that as a group over there at DoubleLine, you've been underweight the AI sector as a whole. Where do you feel, if at all, if it's getting better or more attractive?
It's not getting better or more attractive because the pricing's not better at this point, right? So even though you've seen some kind of correction on the equity side, and it's a small one at best, you still have the bonds trading, at pretty high values. And said differently, they just don't have enough yield to get us interested today. But when you think about the AI trade too, we're only in the early innings of accessing the bond market. The bond market started financing AI roughly about a year ago now, and we've just started to see it really start to permeate that market. So you see this coupled with more equity issuance out there as well. And so in general, the bond investors will be much more discerning because, again, I feel it's a similar kind of story to the SpaceX kind of bond offering this week, right? There's high demand for very shorter dated stuff, but as you go out and finance longer, that means that the revenue story, the earnings expectations have to come into play, and we've got to figure out where that comes from. So we're still staying significantly underweight the AI story, just because, again, we don't think that valuation gives us a chance to actually step in and build up cushion, because a lot of this fervor that you see in the equity market around the AI is what's really leading to letting some of these names price on a very tight level.
All right, Jeff, got to leave it there. Always a pleasure. Jeffrey Sherman, Deputy Chief Investment Officer over at DoubleLine Capital, counting us down, Katie, to those closing bells, and of course, counting us down to those earnings from Micron.
Absolutely. Just a couple of minutes ago, there are really interesting comments from Jeff Sherman. Hope to have him back soon. I'm glad he got that SpaceX bond offering in there because really interesting sign of the times, first to see it happen at all, but also that demand for shorter dated debt. Absolutely.
Meanwhile, back in the equity market, we're off the lows of the day. The S&P and the NASDAQ, those still in the red as we move closer to those closing bells with an eye on those chip stocks and all eyes right now on those earnings coming from Micron. Full coverage of that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell. with a global simulcast. Carol Massar and Tim Stenovic join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, and our partnership with YouTube. An eye on the broad market, Carol Massar, but also an eye on Micron, a stock that fell 14% yesterday. It's been all over the map today, up 3%, down 3%, and now we're going to have a moment of truth in just a few minutes when they report earnings.
Yeah, it's a really good point. As you mentioned, down as much as almost 6% earlier in the session, down just about 1.4%. You know, what it says, CapEx spending, margin, like all these different things will matter, and whether or not it'll give kind of a little bit of some juice maybe to that AI-infused trade, or does it kind of take some more of the air out of it?
Speaking of juice, you guys are talking about what the stock did yesterday and what it did today.
Yeah.
It's up more than 260% this year.
Perspective, right?
It's a lot of juice.
That's a lot of juice.
It's a lot of juice. I will say, though, when it comes to its earnings report, it does have a little bit of a volatile past here. It's fallen on the day after earnings in 5 of the past 6 quarters. You take a look at the options pricing right now, it looks like we're priced for a swing of more than 10% in either direction. So even with all that juice that we've seen year to date, probably some more volatility on the way.
Yeah, and we should point out, we're talking about a company that's expected to report triple-digit revenue growth, triple-digit profit growth, and 80% gross margins. But as we've seen in the past, as Katie was just kind of alluded to, sometimes high expectations leads to disappointment. We do get the closing bells here in New York with the Dow Jones Industrial Average holding in the green, up about 175 points, or about 3 to 4% as we wait for these numbers to settle. The S&P 500 will finish in the red, down 0.1%. The NASDAQ will finish in the red, down 0.4%, and the Russell 2000, Carol Massar, will be up on the day by 0.4%.
All right, good to know. Digging a little bit deeper into the S&P 500, you've got 321 names to the upside, Katie, 180 to the downside, 2 unchanged.
You take a look at the sector level, a little bit more of an even split. Industrials, your biggest performer on the day, higher by more than 1%. Utilities and healthcare also seeing a relatively big bid here. In terms of what didn't perform, as you might expect, energy down 1.7% as oil continues to slide. And then information technology as a sector down about 0.6%, again, as we await those Micron results.
All right. I just want to point out for you to that, Carol, just so we get it out of the way, that Fed stress test of the major banks is out, all 32 banks passing that annual stress test.
All right, good to know. We're waiting for Micron, expected to report any moment now. I'm just going to go to something that's not a chip company, but energy companies. We did see some of the solar companies rising in today's session. Sunrun was up as much as 31% in today's session, finished with a gain of about 12.5%. That's after the company announced a pact with Renew Home and Tesla to deliver more than 16 gigawatts of flexible energy capacity to hyperscalers and utilities. So there is a little bit of an AI trade in there. And you also saw Enphase up as much, up about 1.2%. Also want to take you to the home builders, which we did see a rally in today's session, a gain of more than 6%. This as President Trump canceled plans to sign that bipartisan bill aimed at lowering housing costs and increasing supply until Congress approves voting restrictions.
Yeah.
Keep in mind that bill did include a provision when it came to investors not being able to buy. We got Micron earnings.
Micron earnings are out. The shares all over the map for the third quarter. It does look like results did come in above estimates here. But here's your forecast, what everyone is focused on. Fourth quarter adjusted revenue, 49 to 51 billion. The street was looking for 43. So a big guide above what the street was looking for the fourth quarter on the revenue side. The company also saying that for the fourth quarter, that's the current quarter that we're in right now, gross margin will be 86%. That's an expansion. And that's also above street estimates. They were looking for roughly about 84% on the gross margin side. Micron also saying that its customer base is rapidly growing and it is seeing an increase in demand. I do just want to circle back to the third quarter numbers, the quarter that just passed. It does look like a beat on that front as well. The bottom line number, third quarter adjusted EPS, $25.11. The street was looking for basically $20.49 on the revenue side as well. Katie, also a beat there at about 41.46 billion. The street was looking for roughly about 36.
So a beat when it comes to their third quarter adjusted EPS, also a beat when it comes to their third quarter adjusted revenue, coming in at $41.46 billion, healthily above the estimate of $35.69 billion. You can see the shares moving higher after hours, especially when you take a look, as Romain walked through, that fourth quarter look ahead for adjusted revenue, a range between $49 billion to $51 billion. The midpoint of that well above the estimate heading into this print, which was $43.24 billion, Carol.
Got to say, the adjusted gross margin, that's a big, important number for this company, 84.9% versus 39% year over year. The estimate was 81.9%. We should expect to see margin expansion. This is something we talked about with our Mandeep Singh, this idea that the demand has been out there, the costs have been higher, so you would expect to see that increased level of profitability and certainly margins increasing. The chairman, president, and CEO of Micron, Sanjay Mehrotra, saying the record fiscal third quarter financial results and even stronger outlook for the fourth quarter reflect the strategic value of memory in the AI era.
Yeah, I mean, I really focused on this margin number for the current quarter, 86% versus 83.6%. That expanded. Fourth quarter adjusted revenue coming above estimates, $49 billion to $51 billion. We're also getting some more granularity when it comes to other parts of the business, not as important to the stock move and to investors, but third quarter mobile and client revenue coming above estimates, third quarter core data center revenue coming above estimates, third quarter cloud memory revenue coming in above estimates, fourth quarter adjusted EPS, once again, $30 to $32. That's the outlook. The estimate was for $25.31. Shares up 3.5%. It's a lot, but not really when you look in the context of the move that the stock has made this year.
Yeah, and of course, a lot of people are really kind of keeping a lookout also for those higher end chips. These are the HBM chips. They do say in the release that it is in high volume shipments for its lead customer's platform, and says that qualification samples have been shipped to multiple end customers as well. So that would be the longer term growth story here. The company saying that production on that is well underway and that it does expect volume production on that HBM4E chip in calendar year 2027.
And we know when it comes to those HBM chips, I mean, that's a market that's really controlled by SK Hynix. According to Counterpoint Research, SK Hynix controls about 58% of global market share there. Samsung, Micron had about 21 apiece, according to that research firm. So it's going to be interesting to see what that longer term growth story looks like, to Romain's point. I do want to point out, I mean, shares really extending after hours right now, higher by 6% on top of the enormous gain we saw year to date coming into today. I want to point out, though, that when it comes to their valuation, Micron shares are still priced at less than 10 times estimated earnings. So from that perspective, you could make the case that maybe they look inexpensive still.
We should also point out that most of the chip space now, which was down in the cash session, Carol, all moving higher in the after hours. SanDisk up about 4.5%. Western Digital getting a strong bid. Lam Research, Credo, Qualcomm, and the like.
Yeah.
What about Cerebras?
Yeah, is it kicking up in the after hours? Hey, Dina Bass of our Bloomberg News team doing a quick write through on these numbers and reminding us Micron, the largest U.S. maker of computer memory chips, delivering that sales forecast that top Wall Street estimates after AI-fueled shortages of the components sent prices soaring. So again, revenue will be approximately $50 billion in the fiscal fourth quarter, which runs through August. Analysts had estimated about $43.2 billion on average. X some items, profit will be about $31 a share compared with a projection of $25.31. And again, we've talked and highlighted their margin outperformance, which is so important here, certainly when it comes to what we see. And a third quarter adjusted gross margin, 84.9%. Estimate on the street was 81.9%. Stock now up about 8.5% here in the aftermarket. So the momentum, the upward momentum, increasing here in the after hours.
Yeah, remember what this is about. It's about AI. It's about that spending spree from the data center operators that has stoked the appetite for conventional memory, but also high bandwidth memory, which works with AI systems. So this is why investors are looking at it so closely. Cameron Kreis writing today, this is the third most important company in the world after NVIDIA and Alphabet.
All right, guys, we wrap and we see.
It's the third biggest weighting in the NASDAQ 100.
Yeah, it's a big one, right? Again, the stock just off its highs here in the aftermarket. Micron shares still up about 7.5%. All right, guys, that is our wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. Katie and Romain, of course, continuing there on the close on Bloomberg Television. Tim and I back here on Bloomberg Business Week Daily on Bloomberg Radio. Folks, see you again, same time, same place tomorrow.
And our coverage continues of those earnings out of Micron, a deeper dive into those results and a broader conversation about what it signals for the broader world of AI. That's coming up next here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic. We're going to take a look at the cash session that just finished up here in the U.S. with the SPX, the S&P 500, down for a third straight day. The Philadelphia Semiconductor down for a second straight day, though we'll get to this in a second. That may change in a big way tomorrow. As for what actually happened at the 4 o'clock close, you did see a big bump in a lot of those airline stocks, up for a fourth day to their highest since 2018 as a group. And that's largely a function of what is now a 20% drop that we've seen in oil prices over the last 3 weeks. Biotech's also getting a strong bid. In fact, a 5-day run for the NASDAQ Biotech Index. That's the longest daily win streak of the year, and that price on the screen is a record high.
Let's take a look at some of the day's biggest movers on the individual level here. And something that I wanted to highlight was KB Homes. Even though they reported yesterday, you saw the big pop today, soaring by about 16.7% today. That also boosted a whole host of other housing stocks as well. Also a big day for some of the airlines, as you saw that oil plunge continue. United Airlines in particular rallying by about 7.4% on the day, and also keeping a close eye on SpaceX. A pretty quiet day overall for SpaceX, though it did finish about 1.1% lower, trading at $154, still well above its IPO price of $135, but getting closer. Meanwhile, let's get to our top story this hour, though, and that is, of course, Micron results dropping just a couple of minutes ago, and some fantastic numbers, really, that we're talking about. A beat and raise across the board for one of the most watched reports in months. You've seen shares of the memory chip maker surging around 260% this year, with its market cap surpassing that $1 trillion mark. Now, those gains have come with heavy volatility recently, down about 15% in the last 2 days or so of trading. But taking a look at the after hours reaction right now, it looks like they met which a very high bar in the minds of traders.
Absolutely. Basically a beat and raise quarter by a mile, but it's really the forecast that everyone is focused on there. And this idea here that the juggernaut, when it comes to what we're seeing in the chip space and the memory space, that keeps going. Matt Bryson just earlier this week actually raised his price target, almost tripled it, I believe, on Micron to more than $1,500 a share. Those shares now up 8% in the after hours trade. Matt joins us now, Equity Research Managing Director covering hardware over at Wedbush Securities. Matt, what did you make of the report?
I think the important bogey that people were looking for was $30 in EPS on the guide, and they're going to give us a dollar better than that. So beyond that, everything looked good, Romain. Pricing was up 60-70% for DRAM and NAND respectively. I think that's a little bit below what I thought it might have been. But also in a world where people are concerned that pricing's moving too much, too fast, with them able to deliver the results without, pricing moving more than that, I think that's actually ends up being a good thing.
I am curious when we talk about this idea of sort of how they keep this going. I mean, traditionally, you've covered the stock, traditionally these were always kind of cyclical names. And there's been this idea of this memory fortress that you've talked about, this idea that we've kind of broken that cyclicality, certainly in this AI build out. Do you get a sense here of just how much further this can go from a time perspective? Is this something that investors can sort of have some confidence in, that the growth story, no matter what it is, will be there for more than just another cycle?
I think at the end of the day, these stocks will still be cyclical. You just can't get away from the fact that when you bring on capacity, you bring it on in large chunks, and at some point you have too much capacity. Having said that, So Micron, in their prepared remarks, talks about when some of their new fabs are coming online, and it's late 27. So that production really fully hits in 2028. Up until that point, I mean, they're talking about their expectations for DRAM bit growth being above what they previously anticipated, but it's by a couple percent. And I think that's the struggle here is there is so much demand, yet without these new clean rooms, you can only increase capacity by a little bit. And as long as that's the case and there's this much demand, you just see pricing margins remain really, really healthy.
Yeah, and I do wonder, you think about sort of the medium term, long term. Obviously, right now, it seems like Micron and its peers are the biggest beneficiary of this bottleneck that we're seeing when it comes to memory. But, you have to think that, some of the companies that are ponying up a lot of money, spending a lot of money on memory right now are very much looking for answers and to how to mitigate those costs. And I do wonder, how you sort of think about those longer term risks.
Yeah, I mean, I think that the way that the memory vendors are trying to at least somewhat moderate that risk through the intermediate term is these longer term contracts. And my belief is that a lot of the large customers have signed 3-year, 4-year, 5-year contracts, and that the memory vendors have been willing to give up a bit of future pricing potential in order to make certain that they do have a bit of an elongated cycle. I think that's kind of ends up working for both parties, even if customers aren't happy that they're paying 4x, 5x what they were paying for memory just 6 to 9 months ago.
And so we got the numbers at the top of the hour, beat and raise across many different metrics. We're counting down to that earnings call for Micron. And Matt, what will you especially be listening for in light of some of these numbers?
I think that they gave you a lot of it in their prepared remarks. So Sanjay is going to talk about the fact that over 50% of total demand is coming from data centers. I mean, that tells you how much of this demand is being driven by AI. They told you on CapEx, the CapEx is going to go up significantly next year. In particular, construction costs will be up by $10 billion. I'd love to hear a bit more about kind of how much capacity that can bring on if they offer any granularity, and then exactly how much more equipment spend there'll be, because it both impacts the equipment makers, but also gives us some idea around how quickly some of this capacity might come on.
All right, Matt, really appreciate the breakdown here as we watch Micron shares march higher after hours. That is Matt Bryson. He is Equity Research Managing Director covering hardware over at Wedbush Securities. Romain.
Yeah, we're going to get back to the Micron and the AI story, but we want to focus on big banks for a second. The Fed out with this latest stress test. All 32 large lenders passed the test, showing that they could withstand a severe global shock with heightened stress. And of course, that paves the way for those payouts, which is what investors care about. JP Morgan already out of the gate saying that it is boosting its dividend to $1.65 and planning a $50 billion buyback. And Goldman Sachs saying it will boost its dividend to $5 a share from $4.50.
Meanwhile, I take a look at Jefferies, sort of the odd man out here, sort of reporting out of cycle with their other big banks. They tend to do that. Their second quarter revenue missing estimates. Second quarter EPS also coming in at $1.02. Well below the estimate of $1.24. Jefferies currently down about 3.4%. Coming up, though, we're going to head back to Micron and those results and the broader chip landscape with Gene Munster of Deepwater Asset Management. This is The Close on Bloomberg. Well, we're keeping an eye on shares of Micron after hours, just absolutely soaring following results from the memory chip maker. Gene Munster, he is managing partner over at Deepwater Asset Management. He joins us now. Gene, great to have you with us. Even though Micron shares have been on fire year to date, these results did arrive in a moment where the market has been a little bit stressed over the AI trade and sort of the sustainability of some of these figures. When you take a look at what we learned from Micron about 20 minutes ago, what does this tell you in terms of a temperature check?
I mean, I think it tells us that we're earlier than most expect. And my sense is a year ago, we were in the third inning of this AI build-out. I now think we're in the second inning. And specifically, if you look at that revenue guide that they gave, that 300 and call it 40% revenue growth for the August quarter, that compares to 300 and just under 370% that they just reported in the May quarter. And that just shows you the sustainability to grow, continue to grow at these rates in the face of the law of large numbers is remarkable. And I think just to kind of quickly pull this forward to, this is really the substance of the earnings tonight is what does this mean for the AI trade? And I want to put some specifics around it. The hyperscalers, as Matt mentioned in the previous segment, account for about 50% of Micron's revenue. The hyperscalers for next year, the street is expecting them to grow their CapEx, which is really a proxy for all the infrastructure build, by 22%. Now that compares to what will be up about 80% in calendar 26. Now, interestingly, a few weeks ago, that number for next year was 15%. So we've seen that inch up. But effectively what we've seen tonight, and this is kind of the punchline, Katie, of your question, is that the street is starting to get more comfortable at growth rates for the hyperscalers and the broader CapEx of 40% plus. And what that means is that these companies are going to continue to grow faster for longer than most investors expect. And despite all this skittishness within the market, this is just just a resounding endorsement that we are, in fact, earlier than most believe in the build-out.
Well, you're hitting on something that I've been wondering about, that, perhaps we're getting spoiled by some of these numbers here, because you think about Micron in the most recent quarter reporting a four-fold increase in revenue in the latest quarter. But then you take a look at revenue growth, what it's projected to be in fiscal 2027, growth of 76%, and then 7% in 2028. You could make the case, if you were feeling a little bit bearish, that maybe we are starting to see peak earnings.
Well, I would kind of take that and build on that. And I think that the case is, are investors ever going to get comfortable that we are, in fact, going to continue to grow faster for longer? Said another way is that if the market just continues to take these impressive blowouts and these impressive guides as an indication that we're going to see some material deceleration next quarter, if that kind of fear that we're always going to see a deceleration, if it happens to be 27 or 28, if that just continues to persist, then it's very difficult for the multiple on some of these companies to go up. We've, of course, seen that with NVIDIA. NVIDIA's numbers 3 months ago, the street was expecting mid-20% growth. They're now expecting 40% growth for calendar 27, so it's gone up materially. But the stock over the last month has underperformed the NASDAQ, down 8% versus the NASDAQ down about 5%. And so I think that to me is there's the size of this build out, and I think some of these companies that have gone up so significantly, I do believe that some of those will become more challenged to continue to grow.
So, I mean, the Micron story is interesting, and obviously whatever's going on with the Vera Rubin and its partnership with NVIDIA. But I do want to talk about just how this whole trade, the chip trade specifically, is broadening out. And as we're speaking right now, Gene, you might not be able to see it, but Qualcomm's holding its investor day. The CFO giving some relatively bullish commentary about the potential growth that Qualcomm has specifically in that AI data center space, obviously a broadening of their business away from just that smartphones that we all know and love them for. Do you buy into their ability, and more importantly, some of these other companies' ability to make a more meaningful pivot into AI and actually be a legitimate player?
I mean, we've seen a lot of companies kind of have this new life, whether it's Qualcomm or Intel, and I guess Micron to some extent. And Romain, the simple answer is that I think we are just much earlier than what most believe. And I think that how this kind of continues to expand out, I think the next chapter that still is not fully appreciated is around personalized AI. And this is kind of the Qualcomm angle to this too. It's also the Apple and Google angle. A year ago, if we're having this conversation about what's next, we'd probably be talking a lot about what's going to happen with agentic AI. And obviously that now has kind of been a well-traveled theme. But I think this next chapter, that that chapter being late this year into 27 and 28 will be around that personalized AI. I think you're going to see kind of a resurgence in consumer tech around that. And then probably after that, we'll start to see physical AI become something that is more potent. Keep in mind, despite all the talk of what we've seen in ride hailing and autonomy on that, this year, less than 2% of total Waymo and robotaxi, Uber, Lyft rides will be autonomous. And so I think that that's kind of the sequencing. But overall, this is still broadening out. I think that the market is just uncomfortable, but will be proved wrong that this has got more legs to go.
All right, Gene, got to leave it there. Gene Munster, managing partner over at Deepwater Asset Management. Micron shares on a tear in the after-hours trade. So, too, is Qualcomm, which had been under pressure on some earlier comments out of that investor day. Now up about 7 to 8% here as they talk about that shift away from smartphones and more in the data center, saying they can make up 5% of the data center market long term. When we come back, we're going to talk a little bit about housing. Daryl Fairweather, chief economist over at Redfin. She joins us after the break right here on Bloomberg. All right, we want to go to Washington right now. President Trump clashing with his fellow Republicans in the Senate, canceling plans to actually sign a bipartisan bill that's aimed at lowering housing costs. This is the Road to Housing Act. It was a bipartisan measure, and we should point out, even if the president doesn't sign it, by law, it would go into effect within 10 days, as it has been passed by a veto-proof majority. But there's something more significant here. This is the first time in decades that we've had major housing legislation that focused less on demand and more about how to stoke supply. Daryl Fairweather joins us right now. She's the chief economist over at Redfin to talk a little bit more about this. And I do want to talk about the supply situation, because that has been the bugaboo for the last few years. And it's been the one big thing that I think a lot of folks have wanted to see whether it could be addressed by legislation or regulation. Do you think this bill has a chance of meaningfully making an impact?
Yes, I think that this bill has a lot of great stuff in it. It ties federal funding for local municipalities to their plans to increase their housing supply. It creates guidelines for those municipalities to streamline zoning and to streamline permitting. And that could meaningfully increase the supply of housing. It does require that all of these local governments get on board and take advantage of this money. But I think it's great. I think it's the largest step the federal government has taken on housing since the foreclosure crisis, and it is long overdue.
And, I was thinking about this, too, because I remember, I can't remember, it was like the early 2000s during the Bush administration when they focused a little bit more on mortgage rates and housing affordability to try to get people in the door, with some negative consequences that came with that. This is also, in addition to the idea that it's focusing on the actual supply issue, just is also kind of an acknowledgement of this being a federal problem. And I know that the local governments are going to have to sort of make sure that this actually gets out the door. But how significant is that this is actually now being viewed at the federal level as something that has to be addressed?
Yeah, just a few years ago, I think DC thought of housing as being a coastal problem, a California problem, a New York problem, and not something that was a national problem. But the pandemic really changed that. It turned housing into a national problem because people moved all across the country, and now home prices are up and they're unaffordable to middle-class Americans in the Midwest and the South. Every part of the country has a housing supply problem now, and that's why it's so important the federal government is stepping in and taking a leadership role here, because when you just relegate it to local governments, they have different incentives. They're thinking about their local voters, who are largely homeowners, who aren't thinking about people moving in. They're not thinking about future generations, and it's good to see that these leaders are now thinking about Americans as a whole and not just relegating it to local governments.
Yeah, certainly this bill receiving bipartisan support here. I do want to talk a little bit about some more details of the bill, because as you mentioned, I mean, in your words, there's a lot of great stuff in here, but you also point out that, you think about all the different challenges. This bill alone won't solve all of them overnight if it was, signed into law tomorrow. So in your view, I mean, what are still some of the structural issues at play when you think about this nation's housing market?
Yeah, there are still many structural issues. One that home builders talk about a lot is the lack of construction labor. That has been an issue for decades. A lot of people left the construction industry after the foreclosure crisis, and there hasn't been a lot of entry into that industry. Immigration policy exacerbates that, so that's something that needs to be addressed. Mortgage rates are still high. Interest rates for builders are high, and they borrow to finance those projects, so we still need to work on that. And land prices are high in the places that people most want to live. So I think it's great that this policy is addressing some of the zoning and permitting and also allowing for modular and manufactured homes, but there are a lot of challenges that we still need to work through.
Well, you mentioned mortgage rates, and that's something I'm curious about because, as you mentioned, this bill, it does look at the supply side of things, and we certainly know that has been a bit of a crunch, but we're still dealing with very, very high mortgage rates. So in the event that, more supply is introduced into this market, what is the interplay there as you see it with the fact that mortgage rates are still quite lofty?
Mortgage rates are out of the control of legislators, but the next time mortgage rates drop, and they will drop sooner or later, there's going to be more demand for housing, and builders are going to want to build to meet that demand. So it's important that we clear the way now so that the next time there is a surge in demand, builders can react to that and increase the housing supply. An example of that is what happened in Austin. In Austin, a lot of people moved in. The demand for housing shot up, but builders responded and then prices came back down. We want to see that dynamic play out anytime that there's an increase in demand, that supply can be increased in order to meet that demand. Right now, demand is low, and that's because of mortgage rates, but that could change in the future.
I am curious, too. I mean, I know it's going to take a long time for this build and for this all to get off the ground, but do you think that the focus will be on single-family properties, or will you see a little bit more of a focus on multifamily?
Well, we have a lack of missing middle homes. It's easy to build large single-family homes out in the exurbs in the suburbs where land is plentiful. But what we really need is housing for families in the places where people work. And for that, you need more townhomes, you need more duplexes. ADUs are another way to do infill housing. We need to increase that supply, and that's what this bill mostly focuses on.
All right, Daryl, great to get some time with you. That is Daryl Fairweather. She is chief economist over at Redfin, talking about that bipartisan housing bill that President Donald Trump abruptly canceled plans to sign earlier today. We're going to keep an eye on that story. But let's check in on the chip trade after hours. After Micron reported results at the top of the hour, you can see that Micron shares absolutely soaring right now, higher by 12%. A beat and raise sort of report, and you can see that reverberating throughout the chip landscape. SanDisk also higher by 10%. Qualcomm higher by 9%. They're having an investor day, I believe. But take a look at the effect that that's having in Invesco's QQQ ETF right now. That tracks the NASDAQ 100, which had an ugly day today, but after hours higher by 1.6%.
And we should point out that Sandra Majorota, the CEO of Micron, speaking now and really getting to the heart of why we're seeing these shares rally so much. In his words, basically saying that the tight memory supply will persist beyond the calendar year 2027, and that, in his words, he sees no line of sight to when supply will catch up, though he does say that it could potentially improve gradually in 2028. So if you're an investor in Micron or one of these other memory chip makers, I guess that's music to your ears, that at least in his view, that would give you another runway of at least a year and a half before maybe you would start to worry.
Absolutely. But I think back to a conversation we were having with Kim Forrest earlier this week, talking about how tech companies are looking for a way to get around these high memory costs. She pointed out to an acquisition that AMD made of Next, which is basically looking to optimize memory costs here. So, I mean, we'll see. Certainly, this is the biggest bottleneck in the AI trade.
Absolutely. Obviously, something to keep an eye on here in the after-hours trade. We should also point out the bank stocks continue to rise here on the back of that stress test and the distribution of cash to shareholders. Morgan Stanley raising its dividend. We talked a little bit earlier about JP Morgan and the others as well. We'll be back in a moment. This is Bloomberg.
Well, this year's World Cup expected to set a world record as FIFA's most expensive in history. One way to track the world-class rise in costs is through ticket prices. Back in 1994, the top ticket to the World Cup finals cost a cool $475. This year, finals tickets for MetLife Stadium are going for more than $10,000. Now, our next guest says that this year's organizers, quote, misjudged the market with their restrictive inventory and premium offerings. Joining us live is Dana Lattouf. She is founder and CEO of Tickitto. It's a global ticketing platform tied to more than 90,000 live events worldwide. Dana, great to have you with us. So talk us through what you see as that misjudgment. Are you basically saying that there isn't enough supply here to meet what has proven to be very big demand?
So I think it's super interesting. I was walking into it thinking they misjudged the market and the pricing strategy, misjudged it. They absolutely knew what they were doing. And, my thinking is that FIFA was optimizing for commercial success as opposed to fan sentiment success. So their core KPI would have been, optimizing for stakeholder value, because the reality is the ticket prices are so expensive. As you said earlier, all-time high, really, that, we're seeing tickets go up to $10,000. FIFA thinking this is a global entertainment asset, something similar to the Super Bowl, a Taylor Swift event, or the Formula One, when the reality is it's not. And so their strategy was they're going to push hospitality tickets for corporate buyers, luxury travelers. And while that was successful,
I think we're having some problems with.
They received a lot of pressure from average soccer fans, and so I think there was a mismatch there from what their approach is. And
all right, Dana Lattouf, founder and CEO over at Tickitto, having some issues with their connection. We'll see if we can reconnect on that. But we are going to stay on this topic because it is the talk of the world, particularly here in New York. The World Cup, already the largest ever hospitality program in FIFA and global sports history, according to our next guest. His business provides corporate clients and fans with special access at marquee events, of course, like the World Cup. It's actually the official hospitality provider for FIFA, the Olympics, WWE, the NCAA, and more. Joining us right now on location here in Studio 2 is Paul Caine, the president of the company On Location, which is part of the TKO Group. Great to see you, Paul.
Great to see you again, too.
All right, let's talk about this idea. And we were kind of getting at this idea with Dana, too, about the idea of how FIFA structured the ticket pricing. But you're dealing with customers and clients that, one way or another, want to be here for what most people consider to be the biggest event in the world. Give me a sense here of how that's been structured. I mean, I go around New York City, and when we had just yesterday, we had the head of the New York Tourism Bureau was talking about all the numbers, all the people here. I'm riding the subway. I see all the foreigners. I got on the subway yesterday, and like 10 guys in kilts got on. So I knew they were Scottish, and then they were confused. They were looking for Central Park, and they were on the wrong train, by the way. But give me a sense here as to what you've seen so far.
Well, first of all, sports travel is a booming industry. Yeah. So when people are coming to the city, as you're seeing in New York, and frankly, in all the 16 cities that were hosting the World Cup, we're seeing people come from all over the world. Over 125 countries are coming to North America to see the World Cup. That industry is about $500 billion a year, and it's growing into the trillions. So that's what you're experiencing, is that's where the economic development and value to a city exists. Now, when it comes to ticketing, to experiences, basically the way we see it is a ticket is basically permission to walk in the stadium. That's all it is. And you get to experience the World Cup, which is incredible to do, but that's what a ticket gives you. But an experience or a hospitality package, which is what we offered, takes it to the next level.
Well, give me a sense as to what that means. I mean, you can sit in the stands. I've been in the stands. It's electric up there. I'm probably not in your demographic to afford your hospitality packages, but what does that get me? And what's different than if I just get a ticket, in Section 202?
Well, first of all, you are absolutely can afford our packages because our packages start at $600 a ticket.
Oh, okay. All right.
So let's start with that.
All right.
Secondly is they do go up, and I can go over some of the higher end products if you'd like, but really what comes with it is, first of all, you get to come to the stadium early. Okay. So you're avoiding all the traffic. You can get there 2, 3, 4 hours in advance.
You know how hard it is to get to MetLife Stadium.
Totally. Yeah. Secondly, and by the way, it's New York, New Jersey Stadium, not MetLife. So that's one. Two is once you get on site, you have incredible food. Hospitality, access, all of that is wonderful because now you're not looking and waiting on lines, you're able to get everything you need.
Yeah.
Third, depending on your level of hospitality, there are celebrities, people around the game, athletes, really getting into the center.
Yeah.
And at the highest level of hospitality, you're getting even more access in the stadium and to the fans. Now, on the back end, those hospitality opportunities are open, not only in the half, but also at the close. So instead of sitting in traffic, sit back, have a drink with your friends, have some food. That's what a hospitality package is. But it all is connected to great seat locations too, or suites.
So it's interesting. I mean, the scale that we're talking about, starting at $600 for those more premium experiences that you described. I mean, what kind of numbers are we talking here? Because as we were reading earlier today, that I mean, some of these tickets are being quoted at $10,000.
So $10,000 for a hospitality package would not be unusual, especially for some of the key matches. And the finals, it's going to be more expensive for every ticket, frankly, than that. But where hospitality begins is that $600 ticket, where the highest end can include things like we've got 6 people that are going to be able to sit front row and get on the field to be part of the trophy ceremony, where both the president of FIFA and the president of the United States is going to offer the trophy. That's exclusive. There are also 12 seats in New York, New Jersey Stadium that are literally on the pitch. 12 on the pitch seats. For the finals, that is like an extraordinary experience, like no other. And we've got lots of those kinds of programs attached to it. But again, it goes to be what you want. If you want to just enter the stadium with the easiest access and have the hospitality, you can do it at a relatively low out-of-pocket.
Yeah.
But as you go into these bespoke experiences, the prices go up.
Maybe Katie and I can split one there.
Right?
So,
we'll go halvesies there. And no one cares but me, but it really should be New Jersey, New York Stadium.
It is. That's why we're calling it for the World Cup.
I thought you were saying it's New York, New Jersey.
It's New York, New Jersey. Yeah, you're
it's
right.
actually in New Jersey.
I'm a Jersey person too.
Oh my God.
So I'm kind of
surrounded.
All right. I do want to sort of contrast and compare there, because we're talking about FIFA, we're talking about the World Cup, but as Romain mentioned, I mean, your company is involved with many different sporting events. So how does what we're seeing for this World Cup compare to, say the Olympics, for example, where we also see certainly a lot of big hospitality presence as well?
So On Location is the exclusive partner for the World Cup, but we're also for the Olympics, for the NFL, for the Super Bowl, for all the NCAA championships, for most of the major events of the world. So we're the largest by far in that way. So compared to like a Super Bowl, where there's one Super Bowl for the NFL season, but there's 104 matches across the World Cup. So think about that. So with that, we have similar types of hospitality products and experiences for the Super Bowl. Like you could be on the field for the trophy ceremony for the Super Bowl too. But obviously different price points, different demands. Now for the Olympics, LA 28, that's coming up in just a couple of years. Couldn't be more exciting, right? Right now, people are buying their hospitality and experiences. So people are waiting for their draw.
For 2028?
Right? For those people who are trying to get their tickets through the regular draw, great. There's a small opportunities there. OnLocationEXP.com has everything. You can buy anything right now. You can go to any event right now for LA 28. And I would say the earlier you buy, the better your pricing always is.
All right, Paul, great to have you here. As always, Paul Caine there. He is the president of On Location, which is part of TKO Group. We'll be back in a moment here to wrap up the day and take a closer look at that monster rally we're seeing in the after-hours trade with Micron.
Well, we're seeing some wild moves in the chip stocks after hours. Micron at the top of the board there. That after hours gain now 15%, leading the rest of its peers higher as well after just a terrible day for these chips over the last 2 days. So joining us live with more context is Mandeep Singh. He is Global Head of Technology Research over at Bloomberg Intelligence. So perhaps a case where expectations were actually lowered a little bit heading into this print from Micron, and across most measures here, I mean, they knocked it out of the park.
Yeah, and look, anytime you see 75% quarter-over-quarter growth, when a company is growing over 200%, there's definitely, a big lift that they are getting from pricing, and a lot of that sequential growth is from pricing. They're not shipping more units. In fact, I think the commentary that I just heard was they're going to be supply. They don't even know, if they'll be adding significant supply through 2028. So they're actually giving you guidance for the next 2 years that it's going to be like this from a pricing standpoint.
Well, that's what I'm curious about. I mean, we're talking with Matt Bryson over at Wedbush, Gene Munster over at Deepwater. A little bit earlier off camera, I had a chance to catch up with Dan Ives. And I mean, they're all kind of singing from the same hymnal here, which is the idea that we're still in the early innings, to use Dan Ives' sports metaphor with regard to this AI trade. So when I hear the comments from the CEO of Micron saying that, okay, at least through 2027, we're going to have a shortage, and maybe in 2028 we get a gradual, maybe evening out of this. You're confident in that, or you have enough conviction that what they're saying isn't just them trying to talk their book, that this is structural and long-lasting for maybe the next year or so?
I mean, I would caveat it by saying that if this persists for that long, it may be cost prohibitive for a lot of enterprises to actually invest in AI. And we may be seeing signs of that, with token maxing and enterprises running out of budgets, because everyone went in with the assumption that prices will come down as we scale this technology. Well, it seems to be going the other way around. And that's partly because these memory companies haven't really expanded their capacity. Even now, they haven't really raised their CapEx in a big way. They're pretty much reiterating their CapEx guide when they're beating their numbers by, 30, 40%. And so really, I'm surprised why, everyone is not pushing them to raise their capacity, because they have the demand visibility.
Right. Well, let's talk a little bit just quickly here about some of the ripple effects, particularly, when it comes to smartphones, for example. What does this mean for prices? What does this mean potentially for sales?
I think Apple has already told us that they will be raising prices. I expect the same from every other OEM out there, because right now, the cloud providers are the ones who are signing long-term contracts, 2 to 3 year contracts for memory. Everyone else is getting priced out, and they have to deal with spot pricing here.
All right, Mandeep Singh, who leads our global technology research coverage here at Bloomberg Intelligence. Micron, Qualcomm, SanDisk, Western Digital, all up more than 10% in the after-hours trade as we set you up for what to watch over the next 24 hours. It includes some, non-tech earnings in the morning out of Darden Restaurants, your favorite, Olive Garden, Katie Greifeld, and some non-tech earnings after the bell with FedEx Freight. But it's really 8:30 a.m. tomorrow where we're going to get some key economic data.
Big time. PCE is the big headline there, getting that at 8:30 a.m. But we're also going to get jobless claims, an interesting read on the labor market. And, of course, that tension for the Federal Reserve when it comes to both sides of their dual mandate. Well,
you're going to hear from at least 3 Fed members. And I know you love Fed speak. Mickey Bowman, Williams, as well as Austin Goolsbee, Chicago.
Yeah, there you go.
Guy. So, got to listen to what he says. That does it for us here on The Close. We'll be back tomorrow with all your market-moving coverage for what's happening in the world of politics. Stick around. Joe Matthew and Kaylee Lyons, they're coming up at the top of the hour with Balance of Power right here on Bloomberg.